Okay, so thank you very much for sticking up with us this afternoon. We're going to start this third and last session where we've asked our two speakers to explore the heuristic value of those two concepts of neoliberalization and internationalization from the side of the transformation of the urban built environment. The idea here, and I really would like to thank both Rachel and Antoine for having accepted to share their thoughts on how the production and reproduction of the contemporary urban built environment in city regions rely on circuits of capital that are deeply rooted into financial markets. So these circuits of capital that finance the production of the urban built environment may be linked to securitized debt when bonds, for instance, are backed on real estate, or when some future municipal fiscal income bonds are backed on these types of fiscal income, like tax increment financing that Rachel has been studying. So on the one hand, there is securitized debt that is coming from financial markets, or it can also be directly equity raised on stock exchange market, or it can also be private equity. All in all, what I'm trying to say is that we have a series of circuits of capital that tap into financial markets, and that investment banks, asset managers, property trusts are channeling back into real estate, into infrastructure. And the idea is that this capital is coming to extract some value because it acquires rights over some elements of the urban built environment. And obviously, this process through which a part of the value is extracted and given back to investors on financial market can be a way to discuss both neoliberalization and internationalization. So this process that a number of us call the financialization of urban production can be a site to reflect upon, I hope, these two concepts. First, neoliberalization. What could be the link between neoliberalization and the financialization of urban production? Well, first of all, one may say that maybe purposedly and sometimes inadvertently, it is neoliberalization policies and practices that may pave the way for financial investors to tap into the land rent, so that it can be an important factor that contributes to the financialization. We can think of how large-scale infrastructure development or just PPPs, which may not have been designed to permit finance capital to get into the production of the urban built environment, did come along with these neoliberal, if one may still call them neoliberal, with privatization practices. So it just came in, and at times inadvertently. But vice versa, the unfolding of such circuit of capital may lead to local government adopting neoliberalizing policies and practices. I'm sure we'll see that with Rachel and Antoine at some point, but we do know that, and especially if we follow, for instance, David Harvey's entrepreneurial urbanism paper, where because local governments try to attract, lure in some investors, and including those coming from financial markets, they end up betting against other cities and entering the intra-urban competition. So these two processes may go hand in hand. Similarly, the relation between financialization of urban production and internationalization can be quite striking at times, if only because those international investors and their networks bring capital which is pulled from very distant areas. And that capital goes across scales or national scale which may mean that transnational would actually be a term more appropriate than just international. But obviously, as this process goes on and that the financialization induces forms of internationalization of capital flows, vice versa, one can imagine that these international flows and the expertise that goes along with it, the policy and urban models that come with it, are shaping what the financialization of urban production is. Now, I'm not going to try and play the match between the global and local scale, obviously, which is something from the past, and that has been partly resolved with globalism. But one does see that these international flows are actually channeled through intermediaries that connect different scales, that connect an investment committee from a university endowment fund located on the eastern coast of the US to a soon-to-be urbanized tract of land in Bangalore in India. So there are all these networks that contribute, financial networks that contribute to the circulation across scales of capital. Now, I think we have a picture now where things are getting a little more complicated, because not only did we have neoliberalization and internationalization, now we have also the problem of financialization. And this is my great pleasure to let you two guys grapple with this problem. So I'm really honored to have first Rachel Weber, who is a professor at the Department of Urban Planning and Policy from the University of Illinois at Chicago. You have published remarkable papers on financialization that includes tax increment financing, that includes papers on the privatization and hence financialization of some infrastructure. And of course, your book in 2015, From Boom to Bubble, How Finance Built the New Age Chicago, where you develop the thesis of the key role of local government adopting, I may say, entrepreneurial inspired policies in facilitating the extraction of land on behalf of financial intermediaries and their investors. So this will be you will have I will leave you the floor in just a minute, but first I would like to introduce Antoine Gironnet, who is currently finishing his PhD thesis at LATTS, and he's been working, and inspired by Rachel's work as well, he's been working on a process of financialization of real estate in France, and part of his work has been dealing with the city region of Lyon. And I think the comparison between Lyon and Chicago may be very fruitful. Otherwise, we wouldn't have invited you, of course. But it can be fruitful both because we are in local, regional, and national contexts that tend to differ between the European and the North American political economy and institutions. But at the same time, we have two local governments that have tried to use these circuits of capital to tap into the financial markets and to develop a series of, if not growth-oriented policies, but at least of urban redevelopment based on the transformation of real estate and land market. So now I'm really happy to leave you the floor, and if you do not manage to find a solution to our problem, which is to have these three processes or concepts sorted out by, let's say, half an hour for you, it'd be okay. I mean, we won't hold it against you. So please, Rachel, go ahead.
Can you hear me now? Yes. So thank you to Ludo and to Gilles and to all of you for inviting me here today. And thank you to Ludo for giving the plug for my book. I do think it's pertinent to the topics we've been discussing today, but I want to branch off a little bit and address the questions that were laid out for today's workshop, particularly how globalization, internationalization, neoliberalization, and financialization interrelate. And I recognize that neoliberalism like neoliberalism, financialization is a polarizing and imprecisely used concept. It has been defined in many different ways. Here are a couple of different definitions. One where financialization is used to describe the growing influence, so it's a process, the growing influence of the financial sector on all aspects of life itself. Sort of starting with the 1970s, how we see that even for corporations that were not in the financial sector, a growing proportion of their profits were made doing things like buying and trading options for petrol. Financialization's also been defined as a mode of economic governance that privileges shareholder value and investment performance uber alles, and also as a political economic regime that is, if you may, the sort of late capitalist manifestation of neoliberalism, whereby the structural power of financial capital is enhanced. So I don't believe that we can talk about financialization as being a separate phase or sort of a distinct historical moment from neoliberalism. I think that they interact in different ways. I think the slide that Jenny put up the first session that talked about sort of the different strategies that might be consumed under the definition of neoliberalism that included things like privatization. Financialization could be seen as one of those kinds of pillars. I prefer to use this language because it's a little bit more concrete, a little bit more specific. It gives us a sense of who, what the parameters of, sort of who the actors and instruments and regulations are that we're interested in. So you'll hear me talking more about financialization than neoliberalism. So, and what I want to do today is argue that this process of financialization is simultaneously disembedding and re-embedding capital in the local built environment. That there's a kind of dialectic between abstraction and particularization that we see that involves the complex interplay of global and local, if you will, glocal, even though I don't like that language either, actors, regulatory regimes, and epistemologies. And so this is a kind of slide, and this is basically the synopsis of my talk today. If I send you a copy of the slide, you can all go home, or you can have that second glass of wine. So in terms of the actors I'll talk about, in the field of urban development, in urban planning, we find both global professionals and organizations that move between places like consultants, the big brokerage houses, global developers, money center banks, but also those that specialize and kind of dig into one particular place or in a region. But they assist each other, and I'll talk about how. So local professionals and practices draw global capital into localized assets, and global finance depends on local actors' production of new assets to transact and circulate in global financial markets. So these relationships are complicated and very much interdependent. In terms of regulatory regimes, financialized regulatory regimes at the global and local levels, you may want to call these neoliberal, allow for capital's restlessness, as I've called in past articles, and the attention deficit disorder of capital that allows capital to be easily attracted to one place, but just as easily distracted from it. So these would include governmental and non-governmental practices that remove barriers to liquidity, but also those that provide incentives for capital to touch down in specific places. And then also epistemologies. I think that globalization or internationalization requires the ability to turn something as spatially embedded as a place or a project or a building into something that can be consumed and transacted at a distance. This kind of rationality requires both local knowledge and the ability to create sort of distinctions between places and specific buildings, some that may be right next door to each other, on the same street, but also techniques for abstracting buildings and abstracting that local knowledge into kind of global knowledge or global truths. So in the book and in today's talk, I'm going to discuss the case of downtown Chicago, the Chicago region. The downtown is often referred to as the Loop because it's circumscribed by an elevated rail line. And I recognize both the the disadvantages or the limits of using a single case, particularly one from the United States. I don't want to sort of fall into that trap of what Gilles and Jenny and others have referred to as sort of academic, Anglo-ethnocentrism about processes that are actually quite specific to the United States and to the UK. But my intention in using Chicago as a case is not to make wholesale generalizations about the way all cities operate, but I think it's a kind of instructive, and you may find it an extreme case, and I will allow you to sort of judge for yourselves whether you think my conclusions apply to the cities that you study. So, for example, I think it's important when we're talking about Chicago to realize its spatial structure. It's still an economic region that is mononucleated. There's still sort of one main core despite multiple satellites of employment and housing in the suburbs. It's a huge region that encompasses about 9 million people, I think comparable to Paris. The city itself is about 3 million people. But there have been few, it's on a very flat plain in the Midwest, so there have been very few sort of topographical or physical barriers to the expansion of the city, or of the city region, and yet it maintains more than 50% of its commercial space in this relatively small downtown. It's also a very diverse city, but one that is highly polarized by race and by income. And I think importantly, in thinking about whether or not the insights from Chicago are applicable to other cities, it's a city that has experienced a remarkable consistency and stability of political regime. We've basically had one family rule the city for 40 years. These are the Daleys. First we had Richard J. Daley in the 50s and 60s, and then we had Richard M. Daley, who I wrote about in my book, who was the mayor in the 1990s and the 2000s. So to provide you with a little case within a case, I want to share with you a story about someone who is arguably the most despised person in the world right now, and that is Donald Trump. I fear I can't even bring myself to, you're supposed to say boo whenever I say his name, right? It's kind of a call and response sort of thing. I'm just not going to do that. It's hard. It's sort of like Voldemort. You're not he who shall not be named, right? So you all know that before he was the president of the United States and before he was even a reality television star, Donald Trump was a developer, and he came from a family of developers in New York, and from Queens, which is where I'm from. And after his company, the Trump Organization, emerged from bankruptcy, I think this was the third or fourth time, in 2005, the Trump Organization began building a series of what are called international hotel and towers. This is kind of a model in global cities around the world, and he used that terminology, global cities. So Miami, Vancouver, and yes, in Chicago, Trump proposed a 150-story mixed use, so commercial on the ground floor and then residential on the floors above, 150-story skyscraper. So this would have been the tallest building in the United States on the north bank of the Chicago River. So true to the stereotype of a global developer, Trump displayed little interest in Chicago, little interest in the environment that he was both helping to create and destroy, other than getting his own plans approved. So he demolished this building on the left-hand side, the Sun-Times headquarters. This is a second sort of newspaper in Chicago, and very few people were going to miss this building. Most people referred to it as a kind of coffin in terms of its design. It was kind of a big rectangle. And he had locally based but globally active architects, Skidmore, Owings and Merrill, SOM, big global architectural firm, produced renderings of this massive new building. And even from the early start, when they were building, they were putting out these renderings, it showed that this tower was going to really eclipse many of the landmarks that were very dear to Chicagoans, like the Wrigley Building and the Marina Towers. The proposed tower was going to hurt existing buildings in other ways that were less obvious, given the number of office towers and luxury hotels that were being built downtown at the same time, and the limited number of new entrants to the market. So this is an important feature to understand about Chicago that may again be different in other cities. Relatively little new growth in terms of in-movers, corporations and households to Chicago. In fact, the census demonstrated that we were actually losing households, and that there was a kind of zero-sum game in terms of new corporations that would move to Chicago, but just as many moved out. So there was a very sort of flat employment growth during the 2000s. So that means that if you're going to be putting up new stock, it's going to have to poach tenants from other existing buildings, and that's what he hired the best brokers to do, is to take tenants from other buildings and bring them, give them incentives, often concessions in their rent, a year's free rent, these other kinds of promotional programs to lease up and occupy this building. And much like his attitude about security briefings since he's been in office, Trump disparaged any technical evidence. He refused to read market analyses of the Chicago property market that talked about the possibility of overbuilding. So this is in 2005, 2006. This is exactly sort of the peak of the market, and everything after that was kind of downhill. He didn't really care where his tenants were going to come from. He assumed that his product was so tremendous, so great, so good, that people would just automatically leave their existing buildings and move into this new one. And he also sought to appeal to a kind of migratory, globe-trotting, transitory class, upper class population who maybe didn't want to live permanently in these apartments, but rather just wanted a pied-à-terre in the downtown of a major city. So he was forced to alter the scale of his building. It eventually settled on around 92 stories. There's some debate whether it's 92 or 98. And also the use of the building. So he couldn't lease up all of those floors of commercial properties, so he changed it to what was called a sort of hotel condo model, and then ultimately mostly to condominiums, so individually owned individually owned units. But he was confident that in his ability to raise capital for the construction of the building. He boasted, and I quote, "I get financing very easily. I've been called by 4 big banks today." Whether this was true or whether it was a lie, we won't know, but he was turned down by many banks because of his past bankruptcies, but he was successful ultimately in securing a $640 million construction loan from Deutsche Bank, which was the only bank that was willing to work with him given this sort of his bad credit ratings and his history of failed projects. He raised the rest through his East Coast, his sort of Wall Street connections, with very expensive, what we call mezzanine financing, so very high interest rates. And then he kicked in about $25 million himself. So in early 2008, the hotel section of the building was granted an occupancy permit. In 2009, the condo units were completed. All in all, it was about an $850 million structure and did become the tallest skyscraper that was built in the United States in more than 3 decades. And just in case you would forget who did this, he affixed his famous name in 20-foot tall letters, LED letters, to the 16th floor of the building. But despite all this bombast, the building actually did poorly and continues to do poorly. Some of the early buyers canceled their purchase contracts, even before the financial crisis of 2007. And the building remained half empty through 2011. And even last year, when I checked, the retail space was leasing very poorly. Eventually, Deutsche Bank sued Donald Trump for about $40 million that he put up as a personal guarantee for the construction loan. But then, when he was unable to pay back his debtors, he would not accept any blame. Instead, he blamed the global financial crisis, which he said was an act of God, for which he could not be held liable. And then he initiated a series of counter lawsuits asserting that Deutsche Bank had tarnished his good image. Trump was eventually able to negotiate an extension from Deutsche Bank, but he's also forced to put in a little bit more of his own money. At the end of it all, he admitted that the tower was great and tremendous and fabulous for the city and the residents of Chicago, but, and I quote, "It was not a good deal for Donald Trump, but that's okay." So, why did I bore you with that story of Trump and have to utter his name so many times? What does it tell us about the internationalization and financialization of urban environments? As a development story, it's not exceptional, right? For my book, I collected dozens of these sort of stories of how buildings were built, who the financiers were, troubles that the developers encountered in trying to raise money, those developers that had an easier time accessing both local, regional, and global funds. In its ordinariness, I think it can be an illustration of how large-scale urban projects are built, financed, and financialized, and then sort of help us look at the sort of intermingling or globalization of actors, epistemologies, and regimes. So let's start with the global actors. So the Trump Organization is an example of a global developer, like some of the other big names that operate in Europe and in the United States. So Tishman Speyer, I was talking about Heinz, a developer who's out of Dallas or Houston, Trammell Crow, oops, the related companies. Let's get there. So these are firms that may have gotten their start in a particular city, like Dallas or in New York, and they're headquartered in these cities still, but they are developers that are international in coverage. In some cases, they are publicly traded, so you could purchase a share of the equity of that particular corporation. They're also diversified in scope, by which I mean that they not only develop property, but they operate lending, acquisition, disposition, construction, brokerage and management arms. For example, Tishman Speyer, they build buildings, but they also manage a $60 billion portfolio of 134 million square feet of commercial space. So that's the equivalent of the entire office market in Chicago. And that's global. They own the Paris-Bourse. Am I pronouncing that? That's across from the Paris Stock Exchange. They own, I think, 5 or 6 buildings here in Paris. The other key global actor, obviously, is a financial institution, one of the many that facilitate capital switching into the built environment. So Deutsche Bank is what we call a money center bank. That means that they hold the majority of the world's assets, they maintain a global presence, and they engage in wholesale banking with both retail banks and large corporations. So money center banks provide credit to global developers to build buildings and also to future owners to acquire those buildings from their original owners or original developers. So it's important to note at first this kind of alliance between the sort of largest suppliers of capital like Deutsche Bank and the largest consumers of capital like Donald Trump. And they're both sort of global or international in their operations. In the words of one of my interview subjects, she said, these global developers, she was talking about those that were building office buildings on the perimeter of the Chicago Loop, they can call up New York and get whatever money they want. They don't have to bother with the local. So they can kind of, operate above. Another way in which these kinds of global, actors are related is that they're often the center of legal inquiries. You probably read that Deutsche Bank is in a lot of trouble. They just got a $640 million fine for doing what? For moving money across national borders. In this case, they were money laundering from Russia. Trump is also in trouble for violating certain either kind of national or an international sort of kind of regulatory provisions. And if share price is any indication, Deutsche Bank is, like Trump in my mind, not very popular at the moment, right? Their share price, along with Credit Suisse, has been declining pretty precipitously. But there's another international or another way in which sort of internationalization fits into this whole picture. And that is that once banks like Deutsche Bank make loans to people like Trump or to people buying the condo units in the International Hotel and Tower, they then often sell, not always, but increasingly so, and this is what I talk about when I talk about financialization, they often sell these mortgages to then other actors, many of which are outside of the country where the mortgage was originated. So the use of securitization, here's a diagram, is a key aspect of financialization. After all real estate is financed, right? Money comes from somewhere. It may have come from kings, or from the emperor several hundreds of years ago. But what distinguishes a building being financed from this process of financialization? And I think securitization, to add another ization to your vocabulary, is one of these sort of key practices. And this is the practice of separating income streams from their underlying assets and then selling off the rights to them. So in the book, I write about these commercial mortgage-backed securities. These are novel financial instruments whereby the asset originator, the bank, sells the mortgage to a special purpose vehicle, often within their own firm, who then pools the debt service payments from all different kinds of mortgages on different assets, repackages the whole thing into a bond, and then sells it to capital markets at the end. So rather than hold on to a mortgage on their books, most banks during the 2000s, and then again most recently, 2014 and 2015, when this market started heating up again, decide not to hold on to the mortgage, but to act rather as a conduit and sell that mortgage to someone else, to an investment bank. And then in the process, they make fees that they get to hold on to. So global investment banks, like Deutsche Bank, played many roles in this process of securitization. They both originated loans by making the construction loan to Donald Trump. They also then turned around and sold the loans they made, even though construction loans are harder to securitize and not as much sold on this sort of secondary market. But Deutsche Bank had no problem selling its other loans. And this slide shows how Deutsche Bank was the fifth largest contributor to these commercial mortgage-backed securities during the period I was looking at. They could also be the packager of all these loans and sort of buy them from other banks and turn them into a bond. And then lastly, they could invest and buy those bonds. So they could play 4 different roles in this process. And these money center banks did. They were on sort of all sides of the securitization process. And what was happening in the 2000s and then again in the last few years is that you had investors, many of them global, not living outside of the place where the mortgage was originated, demanding more and more of these instruments, these bonds to invest in. And what that did is put pressure on the originating banks to accelerate the pace of loan issuance. So giving loans to developers, giving loans to people who wanted to buy houses, giving loans to new developers or real estate management firms or REITs or private equity funds who wanted to buy these buildings. So basically it meant that anyone, even Donald Trump, anyone who wanted a loan could get one. And here's a slide where you can just see the prevalence of the use of these commercial mortgage-backed securities in the geography I studied, in the loop, in the period sort of before the worst of the crisis hit. So the global integration of financial and property sectors, I think, should be viewed as a tremendous accomplishment that reconciles the fast-moving financial flows with locally situated built environments. It's the realization, it didn't just happen on its own. It's the realization of many decades of institutional reforms whereby capital controls were weakened, bank activity was deregulated, and risky financial innovations like mortgage-backed securities flourished. And you can call these reforms neoliberal in sort of in tenure. But again, I prefer to say that these banking laws were liberalized, mostly at the national level, to promote a more extensive circulation of capital. So things that took place even in the 1980s, in 1990s that kind of led to this. So in the United States, for example, we got rid of a withholding tax on foreign holders of bonds that were issued in the United States. Or that in the late 1990s, Congress abolished, they sort of tore down the legal walls that were separating investing from banking. So it allowed these large banks to sort of play all sides of the game. Because of the increasingly integrated institutional architecture, more foreign financial institutions entered the United States property market in the 2000s than ever before. To about, I think it's hard to see here, but it's about 18% in 2007. I think, is that right? Yeah, you can see the dollar amount here, but about 18% of total investment in commercial real estate was made by foreign investors. And in Chicago, even though I'm a little skeptical of some of my numbers, about 15% of all of the office buildings in the Loop had some form of foreign ownership. Most of it coming from, and it kind of shows from this image, most of it coming from continental Europe, also from Ireland, from the Middle East, and from Canada. And this was a switch from the 1980s. There was international ownership of property it was Japanese and British. And most recently, you can see in 2015, you see a big increase from Asia, mostly from China. That's in the United States overall. So this money that transnational actors like Deutsche Bank were lending out was also from other countries. So even if the institution, the financial institution, was giving the loan, the money that they were giving out, basically, that they were lending out, was a kind of recycling of trade surpluses and new wealth that was coming from China, from India, from the Middle East, into cities that were considered a safe harbor for that money. And Chicago, being in the Midwest, and its relatively stable political regime, was seen as a good and safe investment. This global pool of money was attracted to real estate, particularly after other global events, like the, thanks. Now we're back. So the financial crises in East Asia and Russia in the 1990s, and historically low interest rates in the United States in the 2000s. Thank you. And then with few barriers, geographic barriers to capital mobility, investors around the world had free range to buy those assets that best met their spatial criteria and to ignore those that did not. Each sector of each segment of the financial sector has its own sort of risk-return requirements and favorite cities, and then submarkets within those cities, and then building or product types. But in this widespread system of absentee ownership, it's safe to say that global actors choose those assets that are most legible at a distance. So if you're a Canadian pension fund, you want to be able to invest in a shopping mall in Boston without having to really know much about that shopping mall or about Boston as its kind of spatial context. And so in the book, I'm kind of talking about a process, which I'll add another ization, of assetization. You have to turn property into an asset, into a financial commodity, before it can be transacted through these sort of global flows. And that's no small feat, given how sort of spatially embedded and opaque and idiosyncratic buildings are. But when chains of property ownership become more international, fragmented, and quick changing, as they are with this process of securitization, financial intermediaries place even more pressure on the assets themselves to be calculable to distant investors. For a building, in effect, it has to appear more like a pure financial commodity, like a stock or a bond, which can involve sort of stripping the asset of its context, of its idiosyncrasies, particularly in the ways that sort of buildings get sort of discussed and represented as you go sort of further up the food chain. You find fewer and fewer of these kind of references to the sort of the specificities of the building or its local context. And when mortgages on buildings are pooled with others to become a mortgage bond, that bond becomes more alienable, which means more easily sold than a building. It becomes, and I quote Kevin Fox Gotham, an abstract object, but one that is capable of ready conversion into an understandable exchange value. And this facilitates their sale across national boundaries. How does this affect the street level? I feel that this process also puts pressure on the physical form of buildings to become similarly abstracted and calculable. So developers talk about creating global products, like the Trump International Hotel and Tower, right? That's kind of a global trademark product that, you know, if you go to one in Dubai, it's like you're going to one in Chicago, right? It's like going and eating at McDonald's across the world. You basically know what they have to offer, even though I've noticed that they have, you know, different food here in France or in Europe. They've made some accommodations, right? So more formulaic kinds of new construction are more easily traded by those lacking local knowledge and spatial literacy. And certain global architectural firms like SOM know how to deliver these kinds of products very well, and plus their reputation helps to inflate the asset's value. In the book, I talk about how in general new buildings, new construction, as opposed to more idiosyncratic, older or historic buildings, are more attractive, just because they are more legible. One of my interviewees, I was talking about the Empire State Building, which is this iconic, you know, historic building in New York. he referred to that building as incredibly inefficient from a financial perspective. Right? It had too much open space, its floor plates were all wrong. He said, it's a beautiful building, but. Is that my time to?
Yeah, it's all right.
Okay. Owners of older buildings therefore have no choice but to seek out smaller amounts of more patient capital from regional banks and regional financial institutions. So it creates this kind of sort of two-tiered system. Now, despite the pressures exerted by global actors for fast and spatially dispersed circulation of capital, finance does not obliterate or destroy space. Indeed, local actors, regimes, and epistemologies must be present in order for financial flows to touch down or gain a foothold in particular locations. And the reverse is true. Local institutions depend on and gain status through their transnational connections, like the article that Ludo in Hortense, right? Wrote about India in the Urban Studies special issue. In Chicago, I interviewed a set of local professionals and institutions that facilitated deeper connections to Wall Street and the European and Asian capital markets. They were not famous developers like Donald Trump, but more anonymous individuals like real estate agents and building managers and planners. Nearly 350,000 such individuals worked in the commercial real estate sector in Chicago at the peak of the millennial boom. And so in this case, Chicago may be exceptional because it has a higher percentage of finance, insurance, and real estate employment than most other cities. But despite this large size, it was a very tight-knit and many argued very culturally distinct group where peer groups, political affiliations, and social connectivity depended on whether or not your deal got done and on what terms. And in this sense, Trump is kind of an anomaly in Chicago, given that he did not have local roots, because most of the developers who were active and those developers created the bulk of the square footage during this boom were not big global developers, but they were smaller ones, but building smaller buildings. Indeed, national studies of the real estate development industry have found that only 13% of large US-based real estate firms actually have any global operations. So you could argue that in some ways real estate was sort of an odd a sector to internationalize it. It has always maintained more of a kind of local presence. And this is also the case of a lot of the financial institutions that were active in Chicago. So sure, Deutsche Bank was active and Bank of America, but you also had a lot of smaller banks that you would never have heard of. But they too participated in this process of securitization. They turned around and sold their mortgages, which were converted into commercial mortgage-backed securities. And although I mentioned how securitization pushes property closer to a sort of pure exchange value, I don't mean to imply that finance can impose its will on the built environment from above. It can't. Financial actors are limited in their knowledge of specific property markets and have a difficult time coming to the consensus about meanings of abstraction like value and risk. So even Donald Trump needed to have people living in his building. He needed to have tenants, real live breathing tenants, to pay off his loans and to even get a construction loan from Deutsche Bank. So the price of the most dematerialized mortgage-backed securities still depends on income streams that are delivered at some location by rent-paying tenants. So occupancy, in other words, is a precondition for liquidity in real estate markets. And ensuring that occupancy requires a host of local organizations and professionals like real estate brokers, and it also involves what I call an epistemology. It's very sort of Bourdieuian in terms of sort of building up the distinctiveness. I was just talking about how we had to kind of abstract real estate and make it more generic, but at a local level, you're trying to distinguish between a building that has this 1980s lobby or this 2000s lobby. And you can't really see that if you're an investor, millions of miles away. So you need local professionals who are kind of making these distinctions and sort of infusing different buildings with different meaning, right? Bringing together different kinds of meaning to convey things like status and prestige. So a lot of this kind of positioning and promoting work takes place at the local level. And then lastly, you also need amenable local regimes that can, and I've talked about this in my previous writing, so I won't belabor it here, but sort of taking issue with some of the neoliberalization literature that sort of seems to imply a real sort of diminished authority of the local state over urban development. But I'm arguing that local governments are often active agents of financialization, even though not always under circumstances of their own choosing. Local governments construct the powers, networks, and contractual frameworks to work with, through, and against finance. So 2 quick examples: zoning. So Donald Trump wants to put up a 100-story building. Zoning says that's not allowed. Maximum limits, I'm forgetting what they were exactly, but I think they were closer to, sort of 50, 60 stories. So how does he go from 50, 60 to 90? He needs to negotiate the zoning, and he does that through a process called planned developments, or PDs, which allow you to kind of allow the local state to make exceptions to the code, to the legal standard, to negotiate. It's a very sort of flexible form of zoning. And of the 600 large-scale downtown developments, about 100 of these were planned developments. And some of the developers said they needed to get this planned development approved. They needed to renegotiate zoning away from what the code said, because it would allow them to ensure that the payment for debt that they used to underwrite the project would be made. So they were making kind of financial arguments for why they needed these zoning modifications. And then lastly, again, I won't belabor it because I've written about it in other ways, the use of TIF, or this tax increment financing, which is a way in which the local government itself essentially securitizes its own property tax base. It takes future property tax revenue and offers it to developers to help them purchase land or helps reduce their financing costs. And happily, Trump did not receive this form of assistance, but many other large-scale developers in downtown Chicago did. It generated about $600 million annually to help subsidize development, and much of which in the downtown. So this is another tool that local government had at its disposal to help knit together global and local financial and property markets. So the fact that cities take on the characteristics of their financial sponsors is nothing new. But today, those financial sponsors are teachers in Ontario whose pension funds are investing in office buildings or shopping malls in Tokyo. And even though these actors don't have much of a voice in what the urban built environment looks like, their financial fiduciaries do and influence both the elevated skylines of Chicago's downtown, as well as disinvestment from many of the city's poorest neighborhoods and suburbs. So the financial sector is a kind of gatekeeper to credit and an enabler of construction and rehabilitation, so determines when cities grow, as well as how and where they grow. But as I said, they don't do this on their own. They require a set of local professionals that help to deepen the relationships between local property markets, global capital ones, and we can discuss in the Q&A whether or not these kinds of interrelationships are indeed problematic. In my book, I argue that they are, that it creates this kind of reinforced incentive structure that can turn what starts off as sort of modest occupant demand into a speculative bubble, and one that we know ended with a big wet pop in 2008, 2009, which then spread throughout the world because everything was interlinked through this global financial architecture that left few countries unaffected.